Hey, good morning, everyone. It's Nick Willis, the Greater Alabama Regional President, PNC Financial Services Group. And we're delighted to have you join us this morning for the Birmingham Business Alliance's Market Insights on the Birmingham Region, featuring our economist, Abbey Omodunbi. In addition to my role at PNC, I also serve as a member of the BBA Board of Directors. Many of you have heard already about the hiring of BBA's new CEO, Kenny Coleman. The Board of Directors and the BBA staff are excited for Kenny to join us Monday, June 20th, and we look forward to welcoming him back to Birmingham. I'd be remiss if I also didn't recognize the leadership of outgoing President Fred McCollum. Thank you, Fred. Godspeed on your belated RV adventures, and we look forward to hearing about them. The BBA leads economic growth and expansion and provides services to create high-quality jobs and a strong economy in our 7-county region, including Bibb, Blount, Chilton, Jefferson, St. Clair, Shelby, and Walker counties. The organization accomplishes this by attracting, retaining, and growing competitive and adaptable companies and talent. Like many organizations, the BBA has pivoted efforts during COVID-19 to serve its investors in the business community. These actions include our COVID resource page and many others. And now on to today's event. After Abby's presentation, we will open for general Q&A. Please submit questions via the chat function throughout the event. Economist Abbey Omodunbi of PNC Financial Services Group will provide key insights on market activity in the Birmingham region and what it means in the context of the global and national trends. I'm pleased to introduce Abbey to you. Abbey, please accept my virtual welcome to Birmingham.
Thanks, Nick. So thanks so much for having me today. I think we would all love to be in the same room today, but these are very unprecedented times and we're getting used to this new virtual reality. Next slide, please. So the US economy got into a recession in February. This is the most severe recession since the Great Depression. It's primarily a health crisis, which spread across the globe. On the bright side of things, the recovery is underway, and we expect the economy to get back to pre-pandemic levels by early 2022. Next slide, please. So before I give you our forecast for the second half of 2020, I'd like to just speak about what we've experienced in 2020 so far. So early on this year, we had record low unemployment. The labor market was very strong. We had very solid wage gains. Consumer balance sheets were very solid. The unemployment rates in February was 3.5%. This seems like so long ago now, but this was the lowest rate since 1969. So it was a very healthy labor market. And then the viral recession started in February. And what we saw after that was a historic labor market slump. So we lost about 20 million jobs in April and May. We've recovered some jobs in May and June, about 7 million, but we're still about 64% away from where we were pre-recession. So one of the reasons why this recession hasn't been as severe as it could have been has been the substantial policy response. So the Fed and Congress have both come together to pull out all the stops to provide substantial relief to the US economy. So in total, they provided about $6 trillion in aid to ease the flow of credits to consumers and businesses in the US. Next slide, please. So going forward, what should we expect? We expect above average recovery in the second half of 2020, but there are downside risks to our forecast. The first downside risk is the path of the virus. We've seen a resurgence of cases in a few states recently. We've seen a resurgence in Arizona, Texas, and Florida. If these cases keep increasing, it could halt the recovery and get us back into lockdown mode. Another downside risk is additional stimulus. So we are going to need additional stimulus from Congress in order to make this recovery strong. Lastly, we also are concerned about consumer behavior. Are consumers going to go out and gather in crowds and spend like they did pre-pandemic? So this is going to affect the strength of the recovery in the second half of 2020. So also we believe, previous slide, please. Also consumer spending and home building are also going to lead growth in the second half. consumer spending makes up about 70% of GDP, so this is going to be a main driver of economic growth in the second half. Home building is also going to lead growth. So mortgage rates are at record lows right now, and also consumers have benefited from both stimulus and also from extended unemployment benefits. And consumers have room to purchase homes going forward in the second half of 2020. So the Fed is also going to leave rates near zero into 2023. The FOMC released a statement saying rates are going to remain at the current level into 2023. We also believe inflation is going to stay below the Fed's 2% objective in the short to midterm. In April and May, we actually had deflation, which is not good for the U.S. economy, because whenever there's deflation, consumers can hold off on spending, and this could exacerbate the downturn. But in June, we had a month-over-month increase in prices, so this is a good sign for the U.S. economy. And this is because consumers are going out, they're spending, and prices are increasing again. So after severe hits to the output, GDP would return back to its pre-recession levels in the first half of 2022. Something else we're going to see going forward is we're going to see structural shifts in retail. The Amazon effect was a theme even before this pandemic. So this is stores going from brick and mortars to e-commerce. It's going to even get more pronounced in this recession. We've seen so many retail stores just filing for bankruptcies. It's like there's like a new store every day, basically just filing for bankruptcy every day. So that's going to be a structural shift we're going to see going forward. We're also going to see downward pressures in the commercial real estate market. As a lot of workers are working remotely, this is going to affect the commercial real estate market, and it's going to be a negative effect in the commercial real estate market. We're also going to see disruptions in supply chains. So we're going to see companies diversify their supply chains, and we're also going to see some companies bring their supply chains home. Next slide, please. So heading into this recession, consumers were in very great shape compared to the Great Recession. So consumer savings rate was close to the blue line, and the left axis was close to 10% going into this recession. Pre the Great Recession, it was closer to 3%. Also, the financial obligations ratio, which is the ratio of consumers' financial obligations to their personal disposable income, was at very manageable levels. So financial obligations includes your mortgage, your credit card payments, your car loans, and so on. So this was at 15%. So consumers weren't spending that much out of their personal disposable income before this recession started. Looking at where that level was before the Great Recession, it was closer to 18%. So this is the right axis and the orange line. So it was at 18% pre-Great Recession. Pre the viral recession, it was at 15%. So consumers were in very great shape heading into this Great Recession, heading into this viral recession, sorry. Next slide, please. But business debt was more of a concern. So corporate debt as a percentage of GDP have been increasing over time. And this was because companies took advantage of low interest rates and they loaded up on debt. On the other hand, earnings were very strong. So if you look at the orange line, interest payments as a percentage of cash flow was at very manageable levels, was at close to 12%. So while business debt was a concern going into this viral recession, companies were earnings were very strong, and companies were able to make their interest payments. Next slide, please. So stock markets don't predict recessions. So stock markets is a leading economic indicator. So what it can do is it can affect consumer confidence. So if consumers are seeing the gyrations of the stock markets, they could make decisions on whether to purchase big ticket items based on how the stock market is moving. So what we see here is that we've had many years in the past where we've had huge declines in the stock market without it leading to a recession. If you look at 1987, we had a decline of about 34%, and that wasn't followed by a recession. Also in 1998, we had a decline of about 20%, but that wasn't followed by a recession. But this time, from peak to trough, we had a decline of about 34%, and it was followed by a recession. Next slide, please. So recessions are caused by imbalances in the economy. The recession in 2008 was caused by an imbalance in the subprime mortgage market. The recession in 2001 was caused by the tech bubble. So there was an increase in tech stock prices, which eventually led to a crash. The recession in 1991 was caused by the savings loans crisis. There was a bubble in the savings and loan sector. The recession in the 1980s was caused by double digits inflation and the Fed aggressively increasing interest rates. So before this viral recession, we weren't seeing any imbalances in the US economy. This was the longest expansion on record. It lasted 128 months. But again, we were pretty much blindsided by this virus. It was primarily a health crisis, which eventually affected economies around the world. Next slide, please. So what has happened in recent months is stock market volatility has returned, and that's again due to the fact that there's just so much uncertainty in terms of, have they discovered a vaccine yet? Is there going to be another resurgence of cases? There's just so much that hasn't been priced in yet into the markets, and we've seen volatility come back to the stock market. So this graph shows the returns of the S&P index, which is the blue bar, and the VIX index, which is the orange line. As you can see in March, as I mentioned earlier, we had a huge decline in the stock market, but markets are close to pre-pandemic levels now. So as the most recent data point here is at about 3,000. So that's very close to where we were pre-pandemic. But we've seen volatility return. So as you can see in March, volatility went up. So the orange line went up in March, again, due to the fact that it's just so much uncertainty, and markets and investors and Americans as a whole just are still trying to figure out and understand the path of this virus and when there will be a vaccine, if there will be a vaccine, and when we'll be able to go back to pre-pandemic ways. Next slide, please. So this chart shows three different measures of economic growth. The first is the gross domestic product, which is the value of goods and services produced in an economy. The second is gross domestic income, which is the income earned by these producers. And lastly, the final sales of domestic product, which is the sales of the goods and services produced in an economy. So the sales to both American citizens and also to foreigners. So all three measures should theoretically be the same, but due to the fact that they are collected by different agencies, there's usually some noise and they're not always exactly the same. But what we can see here is all three measures have decreased in the first quarter. So GDP decreased by 5% on an annualized basis in the first quarter. Our forecast is for the second quarter to be even worse. So we expect the second quarter to decline by 30% on an annualized basis. Next slide, please. So usually whenever there are recessions, it's usually the manufacturing sector that bears the brunt of it. So this recession has been unique in the sense that it's been mainly, the services sector has really bore most of the brunt of this recession. So about half of the US economy is at risk. So consumer durables, consumer non-durables, and also all other consumer services. So states that heavily rely on the services economy like leisure and hospitality, tourism, states like Florida, they've really felt the brunt of this recession. But as a whole, the US economy, about 50% of the US economy has been at risk, and folks at the front line, folks that are in service jobs have really felt the brunt of this recession. Next slide, please. So what we've seen after this recession has been a historic labor market slump. So I'm going to talking about the labor market for the next couple of slides. As we can see, pre-recession establishment employment was close to 152 million. We lost about 20 million jobs in 2 jobs. This is historic. We've gained about 7.5 million jobs in recent months, but we're still a long way away from where we were pre-recession. So it's going to be a long recovery. And as I mentioned in one of my early slides, we're going to need additional stimulus to make this recovery strong. We've also seen a historic number of unemployment claims. So the initial unemployment claims has been over 40 million since mid-March. And even for today, for last week, over 1 million initial unemployment claims were filed. To put things in perspective, the highest number before this recession was 200,000. So we're still at very historic levels. And while things seem to be getting better, we're still a long way away from recovery. Next slide, please. So by so many different measures, by employment labor participation rate by the employment to population ratio. We've just seen a huge slump in the labor market. So the employment to population ratio, which is the ratio of those employed to the working population, declined to a record low of about 51% during this recession. Again, it's just going to take a long time for the labor market to get back to its pre-pandemic levels. Next slide, please. So this recession would have been a lot worse had it not been for the substantial response from the Fed and Congress. So the Fed reduced interest rates to near zero levels. One of the FOMC meetings was actually on a Sunday, which basically shows how unique and how aggressive the Fed has been towards this recession. So this graph shows two interest rates. First is a 3-month Treasury bill, which mirrors the Fed funds interest rate. And what you can see here is that as the Fed has decreased interest rates, the 3-month Treasury bill is pretty much close to zero right now, which is the blue line. The 10-year Treasury bond, which usually is a benchmark for long-term interest rates, has also declined to record lows. And this is due to a few reasons. First, a lot of investors have flown to safety. They've invested in bonds due to the uncertainty. And when investors invest in bonds, the price of bonds goes up and the yields go down. So we're at record lows due to flight to safety. Another factor that has driven 10-year Treasury bond yields to record lows has been quantitative easing. So this is a tool where the Fed electronically purchases treasuries and mortgage-backed securities in order to stimulate the US economy. And when they purchase these treasuries, the price of these treasuries go up and the yields go down. So due to the aggressive monetary policy by the Fed, we've seen both short-term and long-term interest rates decline to record lows. Next slide, please. So Congress also has aggressively implemented stimulus to help this recovery stay strong. So there are actually 3 different rounds of stimulus, the third one being the CARES Act, which was the most aggressive one, which is over $2 trillion. So this had provisions for small businesses. This had the Paycheck Protection Program, which has been very beneficial to small businesses. This also had provisions for states. This also included the extended unemployment benefits, which expires in July 31st. And this also has provisions for nonprofits as well. So this has been one of the reasons why this recovery has even been able to stay on for the short amount of time it's been on for so long. Next slide, please. So the question I usually get after that is, what about the budget deficit? What should we do about the budget deficit? And my response will be that is more of a mid to long-term concern. The more imminent issue now is getting Americans back to work. As I mentioned earlier, over 20 million people lost their jobs. The unemployment claims are still at record levels. And for now, that should be the more imminent issue, just getting the US economy back on the path it needs to be. The budget deficit is projected to be close to $4 trillion this fiscal year. I mean, that's a large number, but again, that's more of a mid to long-term concern. And also on the bright side of things, treasury yields are very low. So now is a good time to issue debt, because yields are very low. So it should be more of a mid to long-term concern. The budget deficit issue should be more of a mid to long-term concern. Next slide, please. As I mentioned earlier, the Fed pulled out all the stops to stimulate the US economy. This chart shows the Fed's balance sheet in trillions. So as you can see, the Fed's balance sheets includes treasury bills, other treasuries, mortgage-backed securities, and so on. So this ballooned to $7 trillion in the first quarter. Again, because the Fed really did pull out all the stops to stimulate the economy and to ease the flow of credits to consumers and businesses. Next slide, please. So deflation was a concern early on in April and May. As I mentioned in one of my earlier slides, month over month, we actually saw a decrease in prices. Thankfully, in June, Prices are increasing, so we had an increase in prices in June, and this is a good sign for the U.S. economy. This chart shows the five-year forward inflation expectations. So it's basically what investors expect inflation to be 5 years from now. As you can see, it's still near 1.5%, which is still below the Fed's 2% objective. But on the positive side of things, prices are increasing, and if that continues to be the trend, it's a very good sign for the U.S. economy. Next slide, please. So we expect this to be a short and intense recession, a short and severe recession, a quick one too. Next, can you just click next, please? We expect GDP on a year-over-year basis to decrease at 8%, and we expect the recovery to start in the third quarter of this year. And we expect the U.S. economy to get back to its pre-pandemic levels in 2022. Next slide. We're also going to see huge declines in the unemployment rate. Next slide. We're going to see the unemployment rate go as high as 13% on a quarterly basis. That's looking at the right axis. And we're going to see a gradual recovery of the labor market. And it's going to take us a while to get back to the pre-pandemic levels of unemployment, because we're at close to 3.5%, which was the lowest since 1969. So it's going to take a much longer time for us to get there. But still, we expect the recovery to keep going on from the second half of this year into 2022. Next, please. So this chart shows the state's coincident index. So it's the level of economic growth around the US. The more green a state is, the more growth the state is currently experiencing, while the more red a state is, the more contraction the state is experiencing. As you can see, June 2, 2019, pretty much every state was doing very well. Most of these states are in green, so there was economic growth. Next slide, please. And I'm not even sure why I'm showing you this map. So this is what we have now. So May 2020 is the most recent state's coincident index. As you can see, this recession has been nationwide. It's been widespread. Every single state has felt the brunt of this recession. Next slide, please. Now, Alabama has a few strong factors going on for it. And this is why it hasn't really felt the severity of this recession as much as other states. The first thing is it has below average population density. It's not as dense as a lot of other states like New York or Florida. Secondly, it has a very low share of seniors compared to other states in the US. And thirdly, Alabama and Birmingham don't have as much exposure to the service industry as other states in the US. So this chart shows the percentage of employment of various services industries in Birmingham and Alabama compared to the US. As you can see, the professional and business services, which is the first bar chart, both Alabama and Birmingham have less of an exposure than the US. For leisure and hospitality, both Alabama and Birmingham have less of an exposure than the US. Transportation and utilities, it's about the same thing. Retail, Alabama has slightly more of an exposure, but it's about the same exposure with Birmingham and the US. But putting it as a whole, both Alabama and Birmingham don't have as much of an exposure to the service industry, and this has greatly benefited both economies. Next slide, please. So while that's a positive for both Birmingham and Alabama, we've seen huge declines in both Birmingham and Alabama. So this chart shows establishment employment. The green line is the US, the orange line is Alabama, while the blue line is Birmingham. As you can see, regardless of the minimal exposures to the service industry, both economies have still seen just drastic labor market slumps. There's been a huge decline in established employment in Alabama and Birmingham, and both the unemployment rates in both economies have really shot up in recent months, again, due to this viral recession. Next slide, please. So even after this current crisis, one of the bigger concerns, long-term trends, is the population. So Population growth is needed in order for there to be an increase in GDP per capita. So this chart shows the population change in the US, in Birmingham and in Alabama. As you can see, both Alabama and Birmingham have very low population rates. They both had both very low population changes in recent years. In order for there to be substantial growth, just strong growth in both economies, there need to be ways to just improve the population of both economies in order for there to be an improving GDP in the long term. Next slide, please. So putting it all together, our expectations for the second half and going forward, we expect above trend recovery in the second half. We expect GDP to increase by around 14% in the third quarter of this year and then 8% in the fourth quarter. The downside risks, again, are the path of the virus, additional stimulus. Congress will need to add additional stimulus in order to make this recovery strong, and also consumer behavior. Consumer spending and home building will lead growth in the second half of 2020. The Fed is going to leave rates at its current level into 2023. Inflation is going to remain below 2% in the short to midterm. We don't expect GDP to return back to its pre-recession levels till the first half of 2020. And also we're going to see structural shifts in so many different industries, including retail, commercial real estate, and we're going to see so many supply chain disruptions going forward. So that's the end of my presentation. I'm happy to take any questions. Thank you.
Abby, thanks for your presentation, and we'll turn it over to Emily Jerkins with Birmingham Business Alliance to host the Q&A section.
Thank you, Nick, and thank you, Abby, for a great presentation. Everyone, please drop questions into the chat, but many of you already submitted some questions through the registration process, so we'll begin to answer those now. Abby, one of the first questions are, the CARES Act put a moratorium on foreclosures through July 25th, and we saw that it also put an extension on those additional unemployment benefits through the end of July. How do you see these dynamics impacting the housing markets? I know you talked a lot about the mortgage rates are going down, which is making all the millennials like myself excited about home buying for once. And but then we also see these other dynamics happening in the market. So just tell us a little bit more about what you expect to see there.
All right, so we expect there to be additional stimulus in the U.S. economy. It's going to be a very lukewarm recovery without additional stimulus. As you mentioned earlier, these unemployment benefits are going to expire by July 31st. And, lots of consumers are going to need additional, stimulus in order to keep this recovery strong. So additional stimulus is going to be needed in order to, keep the recovery strong.
Okay. Tell us a little bit about, you've talked about federal stimulus like PPP and some of the other things through the CARES Act, which have provided that stimulus that we need. Any recommendations on things that can be done at the local and state level? We saw just last week, Governor Ivey announced the $100 million Revive Alabama Small Grant Fund, and the city of Birmingham in April launched a small business grant. But anything you're seeing across the nation, I know we've got some elected officials on the phone, and that they can be thinking about as we look to stimulate Birmingham's economy.
Sure, right. So actually, local and state governments are under severe pressure in order to meet their budget projections. Again, this is due to the fact that a lot of states didn't collect any tax revenue over time when consumers were locked in for a couple of months. So there will need to be additional stimulus passed to states and local governments in order to help them to meet their projections. On the bright side of things, consumer economic activity has resumed, so people are going out to spend. But again, there's just going to need to be additional bills being passed by Congress, mainly targeted at both states and local governments in order to help them meet their budget projections.
Right. Thank you. Got a question here from Samuel Hewitt. With the shift of so many businesses moving to an online platform, do you think smaller businesses have a chance to compete with larger businesses on this? And what trends are we seeing with just the changing consumer dynamics and the fact that everyone is doing more online shopping?
Right, so consumer preferences are changing, work preferences are changing. This is going to benefit, software communication companies who actually provide services for remote work. I think some trends we're going to see will be many retail stores going online. So we're going to see an increase in e-commerce. We're also going to see self-service automation. So we're going to see lots of restaurants and hotels using self-service automation products because consumers may not want to gather in crowds and they may just rather communicate with a machine. So, companies that provide such services, we're also going to see a trend there whereby those are increasing over time. So besides that, we're also going to see just lots of companies bringing their supply chains back home, because I think this disruption has made a lot of companies realize that they need to diversify their supply chains. So that's another trend we're going to see going forward.
Right, and to that point, and as economic developers at the BVA, we're thinking about our strategy and how we can try to attract some of that foreign direct investment and reshoring. Any more specific thoughts of trends you're seeing there and the kind of industries that are looking to reshore?
Right, so in Alabama, we're seeing a growth in healthcare industries. So we're seeing over time, there's been an increase in healthcare companies. In terms of just trying to drive commercial activity from both Alabama and Birmingham, I think both economies, while they're very strong, they could also diversify a little bit more in order to attract, that foreign investment.
Thank you. I have a question here from Commissioner Ammons. What would you anticipate for the next round of stimulus at the federal level? Any thoughts on what we're going to see there?
I anticipate it being just as aggressive because I wouldn't want Congress to feel complacent or feel comfortable now, given that we've seen an uptick in various macroeconomic variables and economic activity on the national level. So I expect it to be as aggressive, and I wouldn't. And if the unemployment benefits are extended, I would expect it to be extended to at least the end of the year. Again, due to the fact that cases are going up so folks don't know if there's going to be another lockdown. So I expect Congress to pull out all the stops and just be as aggressive as they were for the CARES Act for the second round.
Okay. To that point, so David Scher asked, when we talk about Birmingham within this data, are we talking about the city of Birmingham or metropolitan Birmingham area, that 7-county territory?
So we're talking about metropolitan Birmingham.
Thank you.
Okay, sure.
Any other thoughts on, you kind of covered this, but we had a question on how many current industries do you anticipate will fade out or transform into new untapped industries? Any additional thoughts on that and that kind of dynamic we see between, retail? We were already seeing that Amazon effect, which we talked about earlier this week. Can you talk a little bit more about that and trends we might see and how that may impact jobs across the country?
All right, so we had seen a huge decline in retail jobs even before the pandemic. So on the year-over-year basis, retail jobs were declining. We've seen in recent years that consumers just feel more comfortable just shopping online as opposed to going to the mall. That's going to be more pronounced even during this recovery, because a lot of folks still don't feel comfortable, going out and gathering in crowds. So we see that even being more pronounced. So besides retail, we're also going to see, like software communication companies, I think just be more Zoom, exactly. Yeah, Zoom. Yeah, Zoom. Yeah, we're going to see companies like Zoom basically just play a bigger part. Because lots of companies are going to be using them for things like this.
Right. So to that point, we have a few folks that are from the construction industry on the call. Talk to us a little bit about, you hit on this with the home building, within residential, commercial, industrial, any trends or thoughts, forecasts around how the construction industry has been impacted this time around compared to what we saw in the Great Recession with the housing bubble?
All right. So one of the great things about the construction industry in this recession was that construction remained an essential activity in many states, even while there were shelter-in-place restrictions. So construction went on. There was still a lot of construction activity. So I mean, while there's been a collapse in demand for homes because consumers were locked in for a while, there's also been a shortage in supply. And we think that, going forward, as the demand improves in the um, second half of this year, that's also going to be a boost to the construction industry.
Okay. And going back to, all consumers and where people live, something you pointed to in one of your last slides was this whole idea that Alabama and the Birmingham region prior to this was really seeing relatively low, stagnant population growth. We were seeing in the news that there's people are leaving out of, larger cities like New York and San Francisco and heading elsewhere. How do you think cities like Birmingham could capitalize on this, and what trends are you seeing so far on the migration front?
Right. So we're seeing those trends. We're seeing a lot of folks, a lot of workers just basically relocate from very dense, just very dense cities, like the New Yorks of this world, just go into slightly less dense areas. Cities and states can capitalize on that by making their cities and states more business friendly. They can also, just basically just do whatever they can to just make businesses feel comfortable just coming in. And once businesses come in, then they can hire more people, and that's going to boost economic growth in both the cities and the states.
Right. Be curious to hear your thoughts. So to that point, the Birmingham Business Alliance in the coming weeks will be launching a talent attraction website. And we've all been talking locally about how we can take advantage of people leaving these larger cities. I'm not sure if you've seen these, but there's places like Tulsa with Remote Tulsa, and Savannah just launched these stimulus package where they're actually paying tech workers to move to their cities.
Oh, wow.
Any thoughts on that and trends you're seeing there of people incentivizing people to move?
Yeah, I actually read a few stories about that. No, I think right now there will be a lot of competition from less dense cities and states to attract workers who are moving from the more dense areas. And I think, whenever states or cities able to provide incentives for workers to move in, it's always a good idea. Now it's one thing to attract people; it's another thing to keep them. So.
I know. I'll be curious to see some research on just the long-term, impacts of those programs and how we see the retention of talent.
Right.
Okay. Let's see. I've got a few more questions that have come in. How do you evaluate the impact of the federal small business aid funds on small businesses? And this is from a fellow economist. So any thoughts on that? And, something we've heard too is that we're trying to monitor PPP because we are concerned, BBA and our partners helped all of these companies try to get PPP funding and then are now working to try to help on the loan forgiveness front. But there is some concern that, they were able to temporarily bring those workers back, but are they going to be able to keep those workers on once that stimulus period is over?
Sure. What's the first part of the question? Sorry.
Yeah, I realized that was a few questions in one.
Yeah.
So the first part would be, how do you evaluate the impact of federal small business aid funds on small business? Okay. And this might be more of a technical question because, again, it's from an economist.
So. Yeah. I think on a very high level, I think the CARES Act has been very effective in keeping businesses open. And I know initially there could have been some misuse made in some companies that really didn't need the loans were actually getting the loans. But I believe over time they figured things out and straightened that out. And the companies that actually did need the loans and the grants were able to tap into these resources. So it's actually been extremely beneficial. And had it not been for PPP and many of the loans targeted at small businesses, this recession would have been a lot worse.
So to that, we did a survey, the BBA, with our regional partners back in April when all of this, it was late March, early April, and we had an array of companies respond, both small, medium, and large. And some of the larger employers who responded said that some of their pressing concerns were these large corporate debt levels. And you talked a little bit about that at the beginning of your presentation, but could you tell us a little bit more about, it seems like there were some other indicators showing that maybe that isn't as worrisome as some may think. Thoughts on certain industries that are more impacted than others? And
No, right. So, I mean, so pre the viral recession, it was a concern. A lot of companies were loading up on debt. I think like retail industries, cruise line industries, energy industries, those are sectors that, will probably struggle with your corporate debt again, because many of those companies haven't been able to maintain good earnings during this recession. The cruise line industry has pretty much been shut down. That's going to affect how much of the interest payments they can make. So those sectors are, areas of a much bigger concern just when looking at the corporate debt sector. But as a whole, as long as companies continue to have pretty solid earnings and are able to make their interest payments on time, we don't see that being a huge issue at this point.
Okay. Let's see what else we have here. So one of the, well, I think we hit on this one. Does anybody else have any questions they would like to ask Abbey before we conclude today's program? I think any final thoughts from you, Abbey, on just, I think I mentioned this earlier, but
Sure.
in Birmingham, we have been impacted negatively, and
Right.
small businesses are struggling, and larger businesses. But what we have found with some recent data is that, the unemployment rate, it's been better than 85% of the other metros based on the May data. And from a recent census report, out of the top 50 metros, Birmingham small businesses were actually most optimistic about the outlook, and then also just had not been as largely impacted as other small businesses in other markets. You talked about those different industries and how we're structured a little bit differently and how that's helped. Can you think through just any other reasons why that might be, that there's a higher level of optimism in our market?
Right. So pre-recession, the unemployment rate was close to it was about 2.5% in Birmingham. So things were extremely good from a labor market perspective until this recession hit. Besides the minimal exposures to those service sectors industry, the Alabama economy, has 5 military bases, right? So there's also like a large defense sector in Alabama, which has given it some cushion from a viral recession, because military bases aren't as affected, or like the defense sector isn't as affected by the viral recession as other sectors. So besides the minimal exposure to the service sector, just the makeup of the economy as a whole just puts it in a very strong position to be resilient to a recession like this, and also to make a very strong recovery.
Right. With the shift we're seeing, it's really accelerating the need for regions and companies to reskill workers or upskill workers. And I think that's something our region's grappling with now, is we have 1 out of the 2 jobs that were lost in April and May were in the leisure and hospitality retail sectors. Any thoughts around just the importance, I think, layering that in with automation and what we see there? Any trends you're seeing around just on the reskilling and the automation front, and how that might be accelerated because of this?
Right. No, I think that's actually more of like, a national trend, because we're going to see automation play a bigger part in the economy going forward. So we're seeing lots of workers, just go back to school to like learn new skills again, because that's a trend that's we're bound to see in the short to midterm. It's going to be like more automation and more workers just going back to learn new skills in order to add value to the economy.
Absolutely. Well, with that, Abbey, this has been wonderful. Everybody has great things to say in the chat. It's been really insightful. Any last words that you'd like to part us with?
So last words, it's been a very severe recession. It's been the most severe since the Great Depression. Economic activity is back trending upwards. Folks are out now, so we're able to go out, spend, and just generate just economic inputs both on the state, city, and national level. And we expect this recovery to keep going on and reach our pre-pandemic levels by 2022.
Thank you, Abbey. With
Sure,
that,
so
we really appreciate you being here with us today. We really appreciate PNC being our sponsor. And Nick, if you're available, I may pass it back over to you to say our goodbyes for the day.
Yeah, thanks for joining. Thanks, Abby, for joining from Pittsburgh, and Emily for hosting the Q&A. And I look forward to seeing many on the phone in person sometime real soon.
Sure.
Stay safe and stay well.